Good afternoon friends, I hope you're doing well. Today I came here to discuss about the margin trade facility, that is MTF, very renowned word in the stock market. Now how does it work? I'll tell you later. If you want to know definition about it, I have already mentioned in the captions, you can read it out. Now, if I'll explain in very simple words, it is a facility which the broker provides to an investor to invest in a stock market. Now the question arises, how does it different from the intraday leverage? Friends, in intraday you have to square off your position in the same day. But in MTF, you can keep investing yourself for a longer period. Now the second question arises, are all stocks comes under the MTF facility? The answer is no, not all stocks. Now another question arises, is risk involved in it? Now the answer is yes, it does. Now the question arises, how much broker does pay to you under the MTF facility? Friends, suppose if you want to buy any stock and that price is approximate 100 rupees, and if you have only 50 rupees in your pocket, then what you will do, you will buy a stock under MTF facility. Then 50 rupees will be provided by the broker. Now you can buy the stock. And now how does it charge the interest on it? Basically, the 50 rupees provided by the stock broker, he will charge the interest on that capital, and the interest is 0.04%. You might be thinking it's a very minimum interest, but friends, if you calculate it annually, it is 14.99%. Means you have to pay the interest 15% annually, irrespective of your profit and losses. Now, if you are having the profit, then it's very easy to pay the interest. But if you don't have the profit or you are bearing a loss, then additionally you have to pay the interest to your broker on the capital borrowed. Now, how does it work? Basically, suppose if you want any stock at the MTF facility, then you have to pledge that stock to the trader, means to the SEBI. What happens? After pledging that stock, the authority comes to the broker. So, on the time to time basis, he does charge the interest on you. Suppose if you are paying the interest on a regular basis, it's good. No need to worry about anything. But suppose if you don't want to pay any interest, then what the broker will do, he will try to square off your position, and by time lapses, he will square off your position if you don't pay the interest in the condition of losses. So if you are having losses and not paying the interest to the broker, he will try to square off your position. Means you have to bear the loss at any cost. So if you are very sure to buying any stock and that would go at the higher level, then you can buy the stock under the MTF facility. But if you are not sure that stock will go at the higher level or might be it can suffer the loss, then don't go for the MTF facility. That is likely to be the credit card facility provided by the banks. Means if you buy something under the credit card facility, you have to, if you don't pay the full amount, you have to pay the interest, and that interest calculated